If you're over 65, tax changes don't usually arrive with flashing lights. They arrive quietly, inside technical language, temporary provisions, and IRS guidance that most people never read. Tonight's story isn't about hype or promises of free money. It's about how a specific *type senior focused tax relief is being discussed, structured, and misunderstood, and why confusion around it can lead to bad decisions if you don't separate what's confirmed from what's still developing. Over the last few years, Congress has increasingly used the tax code as a pressure valve to respond to rising costs faced by older Americans. That part is not new. What is new is how targeted some of these discussions have become, especially around deductions that apply only after a certain age. Here's the factual baseline that matters before we go any further. Under current federal tax law, taxpayers who are 65 or older already receive an additional standard deduction on top of the regular standard deduction. This age-based increase has existed for years and is clearly defined in IRS publications. That is confirmed, permanent law unless Congress changes it. Where things become less clear, and where a lot of online confusion starts, is when temporary or proposed provisions are discussed alongside permanent ones. In recent legislative cycles, lawmakers have floated and, in some cases, passed temporary tax measures aimed at seniors. These are usually tied to broader tax packages, often with expiration dates, income limits, and conditions that matter just as much as the headline number. As of now, there's no single permanent, universal new senior deduction that automatically applies to all taxpayers over 65 without qualification. Any additional benefit beyond the existing age-based deduction depends on three things that must always be verified. 1. Whether the provision is actually enacted into law. 2. Whether it is temporary or permanent. 3. Whether income thresholds or phase-outs apply. This distinction is critical because tax benefits aimed at seniors are often designed to help low- and middle-income retirees first. That means eligibility is rarely unlimited, and the value of a deduction can shrink or disappear entirely once income crosses certain levels. Another point that needs to be clearly stated, because misinformation spreads fast here. Changes to deductions do not automatically change how Social Security benefits are taxed. The formulas that determine whether Social Security income is taxable are set separately in the tax code. A deduction can reduce taxable income overall, which may indirectly affect that calculation, but it does not rewrite those rules on its own. From a policy perspective, analysts see these senior-focused tax discussions as part of a larger trend. The federal government is trying to balance three competing pressures: an aging population, rising healthcare and living costs, long-term revenue stability. Temporary deductions are one tool lawmakers use because they provide short-term relief without locking future Congresses into permanent revenue losses. That's why expiration dates and review periods are common, and why any senior considering tax planning based on a new provision needs to understand how long it lasts, not just how much it offers. So the responsible way to approach this topic, especially for retirees, is not to assume opportunity or danger, but to verify status. IRS rules only matter once they are finalized, published, and accompanied by official forms or instructions. Until then, everything exists in a gray zone between proposal, pilot, and policy direction. That context sets the stage for understanding what is actually happening, what is confirmed, and where people are getting misled, not by malice, but by oversimplification. Now let's move from background into practical reality, how these senior-focused tax provisions actually work when they are confirmed, and where people most often misunderstand them. First, it's important to understand how the IRS treats deductions in general. A deduction does not create money. It reduces taxable income. That distinction matters, because the real value of any deduction depends on your income level and tax bracket. Two retirees can qualify for the same deduction and see very different outcomes on their final tax bill. When Congress authorizes a temporary deduction aimed at seniors, it is usually structured with guardrails. These guardrails take the form of income thresholds, phase-outs, and limited eligibility windows. None of those are accidental. They are designed to concentrate relief where lawmakers believe it's most needed, while limiting cost at the federal level. Income phase-outs are where confusion spikes. A phase-out does not mean an on-off switch. It means the benefit gradually reduces as income rises above a defined level. In practice, many seniors still qualify for partial relief even if they exceed the initial threshold. But because this calculation isn't intuitive, people often assume they qualify for nothing, or assume they qualify for the full amount when neither is true. Another critical point: these deductions are not automatic. The IRS does not retroactively search for eligible seniors and apply benefits on their behalf. Claiming any additional deduction requires using the correct tax forms and affirming eligibility. This is especially relevant for older filers who rely on simplified filing or assume age-based benefits are already built in. There is also a misconception that these provisions are designed only for retirees who are fully out of the workforce. That is not accurate. Many seniors continue to work part-time or draw income from multiple sources. Eligibility is determined by total taxable income, not employment status. Being employed does not disqualify someone by default. From a policy analysis standpoint, this approach reflects a broader shift in how retirement is viewed. Lawmakers no longer assume a clean cutoff between working life and retirement. Tax policy is being adjusted to reflect mixed income realities: Social Security, pensions, wages, investment income, all intersecting in the same return. It's also important to address a rumor that continues to circulate online, that these senior deductions eliminate federal taxes altogether. That claim is false. What they can do, depending on circumstances, is reduce taxable income to a level where federal tax liability becomes very small or zero. But that outcome is the result of multiple provisions working together, not a single rule change. Finally, timing matters. Temporary provisions operate on tax years, not calendar headlines. Even when a rule is confirmed, it applies only to specific filing years and disappears unless extended by Congress. That means planning decisions based on a temporary benefit should always consider what happens when that window closes. Understanding these mechanics is what separates informed planning from risky assumptions. And that brings us to the final question: what this means strategically for seniors over the next few years, and how to approach it without falling into misinformation or fear-based narratives. Let's bring this to its real-world impact and long-term meaning, without hype, without fear, and without assumptions. From a policy perspective, temporary senior-focused tax provisions signal something important. Lawmakers are acknowledging that inflation, healthcare costs, and fixed incomes are colliding in ways older tax structures were not designed to handle. These measures are not random giveaways. They are targeted relief tools, tested over limited timeframes, to measure cost and behavioral impact. For seniors, the key issue is planning, not panic. A temporary deduction should not drive rushed financial decisions, but it should be factored into a broader income strategy. That includes when to draw from retirement accounts, how to time part-time work, and how different income sources interact on a tax return. Even modest adjustments, made with accurate information, can change outcomes over multiple years. There is also a cautionary side that cannot be ignored. Whenever a benefit is time-limited and age-specific, misinformation spreads fast. Seniors are often targeted with claims that exaggerate benefits, promise guaranteed refunds, or imply urgency that doesn't exist. No legitimate IRS benefit requires upfront fees, special enrollment calls, or third-party unlocking services. If someone claims otherwise, that is a red flag. Another important point: Federal deductions do not automatically translate to state tax benefits. Each state operates independently. Some conform to federal tax rules, others do not. That means the same senior could see a federal tax reduction while their state tax situation remains unchanged. Assuming alignment without checking is one of the most common mistakes. Looking ahead, what matters most is awareness. Tax policy rarely changes overnight, but it does evolve quietly. Seniors who stay informed, without relying on rumors or social media summaries, are better positioned to protect their income and avoid surprises. The takeaway is simple and grounded in reality. This is not about chasing a loophole. It's about understanding how confirmed policy changes fit into your existing financial picture, and how temporary rules require thoughtful, not emotional, responses. That's the role of responsible analysis, separating confirmed facts from speculation, explaining impact without exaggeration, and keeping the focus on clarity over clicks. If you want ongoing, fact-checked breakdowns like this, focused on policy, not panic, this is exactly what LawPulse News is here to provide.